All right. We will jump into it. I will move through this relatively quickly. I think the point of the slides are more conceptually directional type comments. As you said, you can download them after the fact and go through them in great detail, and I'm always happy to catch up. I guess just starting out, in terms of population growth, the Sun Belt continues to lead the country at the deficit of the coastal markets. So you're seeing the green through the Sun Belt in terms of population growth. This is projected over the next 5 years. And you look at some of the job growth numbers, and while I was honestly a little shocked to see DFW down at number 8, we're only 20,000 jobs below the number 1 market of New York. I have a feeling New York won't be at the top next year, just guessing. But we do project, and we'll talk about here in a second, DFW kind of sliding back and kind of outperforming the national average, which we were right on par with this year. Looking a little bit at housing affordability, you've got cost to own a home at the top of the left. You've got the cost to rent at the bottom of the left. National average is about a $1,200 spread. It's been elevated. It's staying elevated. On the right, you see renewals. We have seen this consistent even in our high supply markets in the Sun Belt, certainly here in DFW, where you've got a lot of new options in the neighborhood. Tenants are still staying and renewing. We're working on a lot of new buildings that have new opportunities around the corner that they're renewing 55, 60, 65%. So that's pretty consistent across the board. I think when it's interesting, if you think about housing affordability in Texas, right? The national average was a $1,200 gap. You look at the Texas markets here in DFW, $1,600. Actually right at $1,500. Our peak was about $1,600 for this spread. Housing values have come down. Rents have stayed pretty flat, so that gap's closed a little bit. Austin housing values have come down more. Rents have gone down. That gap peaked at about $2,600 in Austin. But nonetheless, all 4 of the major metros in Texas, that gap's wider than the national average in terms of new home affordability or just home affordability. And that in conjunction with just demographic shifts are what's kind of fueling the continued demand for multifamily. This big tranche in the middle, the 74 million, are kind of prime renters. People are choosing to stay in apartments longer because they like the lock and lead lifestyle. Also, there's a lot of people that just can't afford to buy a home, given that last slide. I think it's interesting on the right-hand side, over the last 15 years, the average first-time home buyer has grown to be 10 years older, 40 years old, for buying that first house. This is sort of a catch-all slide for the multifamily market kind of nationally. I mean, you see vacancy as the line, dipped all the way down to the bottom in 21. We had some bad household formation years in 22 and 23, so that vacancy really jumped up. You look at 24, 25, we delivered over 1 million units across the country in the multifamily space. It's important to note we deliver about 3 to 350 every year, so we kind of delivered 1 extra year. I think sometimes this gets overstated when people say, oh my gosh, 1 million units. Well, okay, but we do 350 a year. It's not that far out of whack. And you've obviously seen vacancy tick back up here as we've been absorbing those units. What's changing is what's moving forward. Now, we always find, certainly here in DFW, the third-party data kind of understates the fall off of supply. It's really driven by the fact of just bad data. You get a lot of duplicates in there. They see somebody pulled a construction permit. They assume that deal started. It never started. That deal fell apart. So we would project that actually these starts numbers and the units under construction numbers have actually fallen even further than what this shows, but still significant drops. And then kind of zooming in on DFW, I touched on it earlier. Our job growth has fallen way off. We do expect it to kind of hold its own year over year as the national average continues to fall just a little bit, so we should outperform. But we benefit from in-migration. This slide is people moving within the country to different states. We're just behind Florida, but 400,000 people moving to the state of Texas from other states in 2024. So massive, massive numbers. And we are still leading the nation in population growth. You've got all 4 of the Texas metros in the top 10. On the right-hand side, that's young adult population growth. I believe that's 20 to 34-year-olds. We're adding 35,000 people a year. That propensity to rent is about 70%, which puts you right about 25,000 new renters just from this tranche. Our 15-year run rate of absorption and deliveries in DFW is about 27,000 units. So, just this stat alone is pretty much filling every unit that we're delivering on an average year. Not to mention in-migration, not to mention people staying in multi longer. Oh, I skipped one. We got to throw the coastal markets under the bus. The young adults are actually leaving those markets, which, again, a little bit shocking if you think about New York is losing almost as many young adults as we are picking up in DFW. The Sun Belt has certainly been the mecca of supply. As you see all these major Sun Belt markets, those blue bars are massive. I think of note on this is one, obviously the fall off, which again, we expect certainly in DFW that fall off has been more than 44% from peak to trough. The other thing is you look at, where Austin is. Phoenix is twice the size of Austin. DFW is 3.3 times the size of Austin, and the amount of units they're putting on the ground is almost on par with certainly what Phoenix has been doing. And that leads to this slide. This is the percentage of stock that's been delivered in the last year. So you start thinking about a Phoenix and Austin, at Charlotte, 6-7% of their total stock delivered in 1 year. I mean, just massive percentage overbuilding. And as you look forward, where DFW is down to 2.1% for 2026, you still have a little bit of a hangover in markets like Phoenix and markets like Charlotte, even Austin. And that's where you've already seen in 2025, you're going to continue to see kind of an outperformance of a market like DFW. We've been absorbing the supplies, we've been delivering, and actually we've been absorbing more. If you look at 24, 25, and 26, DFW absorbed 105,000 units. We delivered 98. So, I mean, we're staying well ahead of it. So we're rolling into a 2026 kind of from a position of strength. And if you look at, this kind of breaks down the markets around the state. The three numbers at the top are deliveries up top, the black is absorption, but it's 24, 25, and then the projected 26. So you kind of see the fall off in each one of the Texas metros, but you also see DFW, as I was just mentioning, the black is outperforming the blue. We're absorbing more than we're delivering each year. And that's helping us shrink that vacancy. So DFW is now down inside of 6% in terms of vacancy. All the markets are improving. Houston had kind of a bad year last year. Not a ton of supply, but for various reasons, Houston's kind of underperformed. It continues to sort of limp into 26, so we'll see how that shakes out. Probably be more of a flat year, but the other markets are tightening up a little bit as we go. And then this is the DFW slide. You see a little bit kind of what I talked about from the national basis, where vacancy was back in, the early 2000s. Peak absorption in 21, that underperformance of household formation in 22, 23, we didn't really keep up. That black line did not keep up with the deliveries, which were the blue lines. Then we kind of caught up and we started absorbing 24, 25 going into 26. And you've seen that vacancy drop from the peak of 7.2 down to 5.9 today. We've seen that across all the asset classes. Certainly the workforce housing space is struggling more. You had a lot of undercapitalized owners that acquired assets over the last 5 years. It's a more challenging market to operate in, and so those owners have struggled. So we probably haven't quite seen the bottom in the workforce space, but what we have seen is this sort of stabilizing of occupancy that's going to help everybody kind of finally work through and get those properties turned around. But certainly Class A leading down at 5.4% vacancy, but all three A, Bs, and Cs coming in. And with that, we expect the A's to kind of lead the market out in terms of starting to see positive rent growth. This is projected for 26. We didn't really see a lot of positive rent growth last year in the Class A space, but this is probably going to be the year that the Class C property, more the workforce, starts to get back to break even as opposed to seeing rent loss. Zooming in a little bit on Fort Worth, again, a similar chart, but just to give the context, Fort Worth actually saw vacancy tick up a little bit higher, just a little bit more under absorption in 22, 23. But you look at how steep that vacancy number is falling on the right-hand side of the chart. So really tightening up, very little supply going forward on the Fort Worth side of the metro, which really puts us in a good spot. And with that, Fort Worth actually outperformed with more of a break-even rent number for 2025 as opposed to Dallas being a little bit behind at a -1. But, it's submarket to submarket. Overall, DFW is pretty much flat last year, and flat, honestly, is pretty positive. You look at the submarkets within DFW and just the occupancy. I think what I like about this slide is this is the Fort Worth submarkets. What I like about this slide is the consistency. I mean, not a lot of, if your worst submarket 7.7% vacant, I'll take it. You see Grapevine leading, you see in-town Fort Worth, all of these submarkets saw good improvement in the vacancy factor. So they're all heading in the right direction. You didn't necessarily see that translate last year into rent growth. Some submarkets had it, most submarkets didn't. But again, when you look at those occupancies, how quickly they're tightening and where they are right now, that puts us in a good spot to finally see, a 0 to positive growth pretty much in all these submarkets. Looking at sales, it's a chart we've used forever. I think Hassam Najee, our CEO, first put this up probably 20 or 25 years ago, but just the correlation from the 10-year Treasury to cap rates. What I think is important, certainly you see how tight it got in 22. The treasuries ran up. It took a while for cap rates to adjust. People talk about, buyer-seller gaps, what have you. That certainly triggers that. Now we've seen that start to normalize, but the thing that gets lost a little bit in here is in 22 and before, the 10-year, the 5-year, the 7-year were all on top of each other for the treasuries. So there was no sort of pricing premium to go to a 5-year versus a 10. Now that gap's widened out. It's much more normal. I think the 10 years about 4.25 today, the 5 years 3.85, the 7 years I think 4.05. So you've finally seen that spread grow. Most of our stuff gets financed with 5 or 7 year money. So if you think about it, you're buying that same 5.5 cap, but most people are actually borrowing with a treasury that's a 4.85 5-year. So if you put that on this chart, now you're seeing that gap widen a little bit. You're starting to get back to more of a normal spread between the treasuries and the cap rates. Nationally, in terms of transaction volume, this is 20 million plus. Kind of got back to the long-term break even. You've seen a lot of markets that saw very few trades over the last few years, especially like coastal California. I mean, they are just now getting back to pre-COVID rents in the Bay Area. Just now getting back to it. Everybody else in the country has been way ahead of pre-COVID rents. DFW, though, you look at the 1 million plus, so this would include large transaction, but it also includes all the smaller workforce stuff, kind of the 1 to 20 million. That's been a much more challenging market to clear. A lot of those submarkets are challenged. The properties are challenged. You've seen occupancies in the 70s and the 80s. With just undercapitalized owners that haven't been able to keep up. We're starting to see that debt get cleared a little bit, but certainly the larger transactions of 20 million plus, healthier capital stacks, healthier fundamentals, sellers that, you look at a lot of developers, they could sell right now. Maybe it's a double, maybe it's a single, but they can clear the market, they can make a buck, they can return capital and start over. In the workforce space, most of that equity's gone. In fact, in a lot of cases, in that 60s, 70s, 80s product, the top sliver of the debt is out of the money. So it's going to take a little while for the smaller transactions to pick up. You see just in terms of the per door pricing at the top, it's come down a little bit. We saw kind of peak to trough, maybe a 20 to 25% drop more in the A space in values. Values bottomed in the A space in fourth quarter of 23. We're still probably seeing a little bit of a bottoming in kind of that workforce 60s, 70s, 80s space. That will probably happen this year. So the cap rate across all the product sectors probably stays relatively flat at, low to mid 5s. But what you're seeing though is that workforce product is taking a 6, 6.5, 7 cap to clear. And the A product, you're actually seeing cap rate compression. Most of the stuff we're clearing today is a 5 handle or inside of that, more of a high 4 in terms of an in-place cap rate. So the average probably holds, but you're seeing that it's normal. We're just returning to that normal spread of risk return. I'd say just in terms of outlooks, we are expecting to see probably a plus or minus 2% rent growth across DFW this year. As I mentioned, you're starting to see a lot more stabilization in the workforce space. Probably 25% of that product that needed to get foreclosed on or needed to clear has finally cleared. You're going to see more of that sort of get churned through this year. A lot of those submarkets and workforce that were really challenged a year or two ago, as you saw on the slides, those occupancies have ticked up. So rents might be down, but at least they're sort of setting that base. Capital was covered earlier. Capital is wide. Capital is deep. All the institutional capital is back. There's been a tremendous amount of fundraising in the core plus space. That capital is going to be deployed, and we benefit a lot from debt. So we've got the agencies behind us. We've got a lot of private capital in terms of debt funds. You've got life cos. The agencies' budgets both went up by 20% this year. So there's a lot of debt availability in that plus or minus 5% range. And so it's just helping our market recover, but we got to finish churning through the supply, and DFW is going to lead our way out. So with that, I'm going to turn it over to Sam Ray at Hillwood to talk about industrial.